Hi, this is Scott Brown, Chief Economist at Raymond James, here to discuss the recent Fed policy meeting. As widely anticipated, the Federal Open Market Committee raised the target range for the federal funds rate by 25 basis points, or 1/4%. That range is now 0.5 to 0.75%, still very low by historical standards. The overnight lending rate, that's the rate that banks charge each other. It's a market rate. The Fed tries to achieve that rate through open market operations, hence the name Open Market Committee. Now, the Fed's Board of Governors also approved a 1/4% increase in the discount rate, which went from 1% to 1.25%. The discount rate is the rate that the Fed charges banks for short-term borrowing. What are the implications of this increase in short-term interest rates? Well, we're not likely to see a big increase in the rate on your checking account or savings account. You will likely see some increase in longer-term borrowing costs, things like mortgage rates. Bear in mind that long-term interest rates are a series of short-term interest rates, and so expectations of what the Fed is going to do drive those longer-term interest rates. Now, as it is, the one surprise that we did get was that there was a little bit of a change in Federal Reserve officials' expectations of policy changes for 2017. Back in September, the forecasts were kind of all over the place, but most Fed officials were looking for possibly 2 rate increases in 2017. At this meeting, most Fed officials were looking for around 3 rate increases, but there's still a wide range of uncertainty in these forecasts. So this is the infamous dot plot that many people have been focusing on over the last few years. And quarter after quarter, the dots in the dot plot have been gradually drifting lower. And this was really the first quarter where we actually saw the dots stop falling and actually, in some cases, move a little bit higher. Now, this isn't a big move, and I would caution investors not to put too much weight on the dot plots. The dots in the dot plot are an expectation. They're not a plan of action. The correct answer when you're doing Fed forecasting is always it depends. The Fed is going to be data dependent. That means they're continuing to focus on the job market, how much slack is still there, and they're also focused on the inflation outlook. Inflation has remained relatively low, but could begin to move a little bit higher over the course of next year. So those things are going to be driving Fed policy. And as I mentioned, long-term interest rates can be thought of a series of short-term interest rates. So the expectation that the Fed is raising rates should continue to drive long-term interest rates higher. But we think that pace of increase in long-term interest rates is going to be kept somewhat in check by low interest rates, long-term interest rates that we're seeing in the rest of the world. So we're looking at somewhat better growth next year, but not a whole lot. We saw the Fed officials revise their projections of GDP growth slightly higher. You're looking at maybe a little bit more inflation, but not inflation getting out of control. So the economy's starting the new year in a very good position. The economy in very good shape. We've got a lot of optimism, certainly in the stock market since the election. But the one cautionary thing I would say is that the constraints in the job market may become a little bit more binding as we go over the course of 2017.